My topic is about central bank digital currencies. It's also called CBDC. Some of you might have heard about it. If you have not heard about it, it's okay. I'll explain from basics, so not a problem. So I heard about CBDC in 2021, and since then I've been quite vocal about this topic because I think CBDC has a lot of potential to change the face of banking in the years to come. It'll bring a lot of innovation. It'll bring a lot of efficiency to the payment systems and monetary system as a whole. And it'll eliminate a lot of problems that we have today with respect to the payments and industry as a whole, with respect to money laundering, offshore financing, and let's say tax havens, and etc. It's primarily a business talk, less of technology. Apologies for that. So in the agenda, I will introduce you to what is CBDC. I'll explain why we need it by taking you through some of the problems, because if you understand the problem, then you know why it has to be there. We'll look at some of the implementations, typical implementation of CBDCs, and we'll finally touch upon the technologies that underpin CBDC. So in very simple terms, if I put it, CBDC is a digital equivalent of cash. Okay, so first thing that you may ask is, do we really need a digital equivalent of cash? In fact, you may think, do we really need cash at all? The answer is yes, it is indeed yes, because cash is a very, very powerful instrument. It is a liability of the central bank, means it's in the ledger of the central bank. It is guaranteed by the central bank. It is central bank money. Why I'm saying this is because if your bank goes bust, you can't get any of the money that is in your accounts in the digital form in your account, right? You can't take it out. But had you taken the money out into cash and kept it with in your hand, you wouldn't be affected by the bust, right? You could simply use that money, continue to use that money and transact it, and nobody will say, oh, you took the money from the bank that went bust, right? Because that's central bank's money. So, but cash has a problem, right? Cash is very cumbersome to handle. Cash is very difficult to transact with. Cash doesn't earn any interest. It is difficult to carry. So, what if you get a digital instrument, like a digital equivalent, that has the power of cash? It is central bank's money, yet you have all the modern facilities of the digital payments or digital money. So you would have it, right? So that's CBDC. CBDC is built on cryptocurrency. You would have heard about it by now. It is built on DLT blockchain technology. Mostly, it could also be built without DLT, but it's mostly preferred technology is DLT blockchain. Almost 110 countries are engaged currently in various CBDC projects. Okay, and 64 of them are in very, very advanced stages. So you know CBDC is actually quite important and taking center stage all around the world. There is a statistics at the far end, which says the different stages at which these projects are at this point. Bottom of this slide, you can see the name of the projects that are driven by Bank of International Settlements, BIS. It's the central bank of central banks. they're driving this whole sort of CBDC initiatives all around the world. There are two types of CBDCs. One is retail and one is wholesale. Retail CBDC is the one that we get as a retail public. The digital equivalent of cash that we get is primarily for the retail customers like us, whereas wholesale CBDC is for the banks to transact. Banks already have some form of central bank money, which is the reserves that they can maintain with the central bank and take liquidity out of it. But wholesale CBDC is the actual cryptographic form of it, which comes with lots of benefits that we'll talk about in this session. CBDC has lots of benefits, okay, which I won't be able to cover in this session. The main ones are like financial inclusion, offline payments, transparency of payments. You can get interest on the cash that you hold or CBDC that you hold. There are several benefits, but what I want to narrow down or to discuss today is just two very important points that I think are most important as far as CBDC is concerned. And this is actually how we can get access to sound and safe money through CBDC for general public like us. Okay, this is something people have forgotten or people are not very conscious about, that the money today that we handle in digital form is actually not very authentic, not very safe, but we're not actually aware of this fact. But the moment CBDC comes in, this becomes more authentic. So how can we get access to this more safe money is what is the first topic, which is what CBDC brings. The second use case that I will talk about is on the cross-border payments, which is a very big challenge today. So that's the use case from the wholesale CBDC. So to make you understand, to help you understand the use case about accessing for sound money, I want to tell you a story that actually takes thousands of years ago. The story of leverage. Okay, don't worry about the word. I'll explain it. The story also helps you to understand the importance of CBDC, central bank money, and why is it superior to the digital equivalent which we have in the bank accounts. So as you know, thousands of years ago, people used gold and silver coins as a store of value and medium of exchange, which is what money is meant to be. Gold was good for store of value, but it wasn't great for as a medium of exchange, because it was very difficult to carry this gold across when trading across the oceans and things like that. So it wasn't very good for us as a medium of exchange, but it was very good for store of value. There are two problems with the gold, main problems. One was the logistics, which is the carrying part, and the second problem is the safety, because you couldn't actually store it safely. So the people who had this gold, they looked around and they found, okay, there are goldsmiths here, which they have very strong vault, like a storage. So why don't we store the gold with the goldsmith and then get some notes, right? Notes from the goldsmith that says, I owe you so much gold. So whenever you want to redeem that from me, you can show the note and you can get it. Okay? So goldsmiths gave this so-called IOU notes. I owe you actually gold, whatever quantity that you gave to me to store. But goldsmiths were happy because I can get a share. He got a share of the little fees or charges for storing it. So these IOU notes, people took it and they were quite happy with it, because it not only represented value, but also it was a very good medium of exchange. People could simply exchange these notes and use it as real money, right? So this phenomenon was very popular, got very popular, and the whole society started to actually bring their gold to the goldsmith and say, okay, store it and give me my IOUs. And these IOUs went around the society, went around the economy, and acting as actually real money. All were good until a certain point. Okay, when Goldsmith got this idea, okay, he had two observations. One is that these IOUs are going around the market, going around the economy. Nobody's coming and asking me, nobody's coming to redeem the gold at any point of time because everybody's happy with IOU notes. Okay? So nobody's even coming and saying, show me the gold, because they trusted the goldsmith that it is there. So he got an idea because he also saw another observation that there are people and entrepreneurs and people who want to start businesses. They don't have enough notes or money or gold, but they want to start businesses, they want to start trading, they want to create wealth. So based on these two observations, Goldsmith thought, what if I write some notes, IOU notes, which is not backed by gold? I simply write some notes, let's call it fake notes or imaginary notes, which is not backed by anything. If I write something like that and give it to these people, okay, they will use it for creating the business, creating the wealth, and they'll come back and pay me back at a certain point in time later with some additional fees and charges, right? So he is trying to make money out of his position. He didn't think it was a problem of giving imaginary notes or not backed by notes, because he knew that whatever expansion of notes he made, it will contract when the borrower pays back, right? So it was not creating anything wrong. So what he did, he started to give away these notes for people who wanted to borrow and make some businesses and create some wealth, hoping that they'll come back and give it back. So system as such was good. Okay, there was no problem with the approach itself. So this is the concept of credit creation. It's not called money creation, it's called credit creation. So you go from a point where you go up, create this so-called imaginary notes, not backed by anything, and you wait for that to come back and offset it back, right? And then you make money out of that small little business that you did. Everything was good, but this created the leverage, right? Leverage means you create something, you use a lever. What you cannot do without a lever, use that little lever and create something more powerful. So that's called leverage. So the leverage here is that there are more IOU notes out there in the market, in the economy, which has no proportional backing with the gold. Okay, this is the leverage. It ran a risk. The risk is that if somebody knew about this problem, everybody holding that goldsmith's IOU will come back and ask for the gold at the same time, and there's no gold to give, and there is a run on the goldsmith, right? So people lived with that problem. On and off, goldsmiths ran, there was a run on the goldsmith, but more or less the economy worked in that fashion. But there was a problem, okay? People thought that this goldsmith running this thing is not very good because it's a matter of money. It is very, very important. It has to be a more formalized business. It cannot be run by goldsmiths. It has to be run by more formalized businesses like banks. So state, the government, they chartered banks to do the same thing. The goldsmith IOU notes were replaced by bank notes, which you see in these pictures. Okay, IOU notes became the new form of money. It became currency. Okay, so the IOU notes itself became the money. People thought that, okay, I have to keep it safe, right? So what they did is they brought the IOU notes back to the bank for deposit. So bank now has two structured. They have the gold, the asset, and they also have the IOU notes. It created a structure like that, and it only amplified the credit creation process, right? Because now everything is under the bank's control. So it just amplified the creation of money into the system, credit into the system, and the problem just amplified. There were continued to have run on the banks, right? It was quite common. People go and try to get their money out of the bank when there is a problem. So government did not like that. They said, okay, not only just has to be formalized, but it also has to be regularized, right? There has to be regulations, there has to be government control. So they brought this so-called central banks, okay? They're the wing of the state, they represented the state in some form. They're an entity of the state. In this arrangement, central bank says, give us all the gold. All the banks come and give me the gold, right? I maintain the gold. I will issue the IOU notes in the name of the central bank, okay? Banks don't have to keep the gold. They can't create credit or they can't issue notes. We'll do the same. We do both of these things. Banks simply remain as intermediaries for the customers. So there you can see gold reserves with the central bank. The banks held the central bank issued the notes, right? Surplus notes that the customer had, they brought it back to the bank and they deposited it there. Credit creation still continued, but it was controlled because bank only had that amount of notes the customers deposited to lend out. So the credit creation was controlled. Everything was happy, right? Central banks also introduced what is called a fractional reserve ratio. They said that, okay, you can only lend out a fraction of that deposit that you have, okay? Don't lend out everything because if customers come suddenly, 10%, 20% of your customers come back, suddenly you have to be able to provide that deposits back. So they put a fraction and say, lending is fine because lending is very essential for the economy, but take only a fraction of the money and lend it. So fractional reserve ratio was introduced. Okay, so everything was good. So this is the structure, right? You have a central bank. Bank A kept the gold reserves, 150. Bank B put the gold reserves of 280. The reserves were issued as currencies. Okay, it is out in the market. That's why I'm not shown inside the bank. It is lying outside in the economy, but occasionally it came back to the bank, deposited when there is surplus and all that. But there were more problems, okay? The age of industrialization and liberalization and globalization, all that occurred. And governments found that this controlled way of credit is not going to help the economy to run, okay? Central banks should ease out and they should give more credit into the economy. Only the new businesses can form, new industries can come, new ideas can come, new entrepreneurs can be formed, new collaborations can be formed. So the whole idea of controlled money was not working well, and hence government asked to reduce the fractional reserve so much as that in some countries they became zero. There was no real fractional reserve at all, right? And gold was replaced by other assets because gold was very scarce, and governments thought that it is not a good idea to actually keep gold as an asset because economy cannot grow if you're pegged to a certain limited amount of gold available in the world. So this was actually the stage. It all sets the stage for liberalization and more credit creation. But banks needed a mechanism to do it, which is when introduction of electronic ledgers came, probably in the 70s or 60s and 70s. So in the world of electronic ledgers, deposits were stored as digits, right? The money was stored as digits, represented as in bits and bytes and bits. Okay, it created a new form which is different from the money that you held in your like a bearer instrument, like a cash in your hand. It started to remain within the banks. That's the pink box there. Banks started to create this form of money, okay, of course through credits. It's a credit creation process. But what actually happened with this electronic era is that credit creation became much more easier. It's actually a technique with these electronic ledgers that you create a suspense account, okay, and then just like the goldsmith did the imaginary IOU notes. So you create a suspense account, which is a loan account, and then the amount of credit that you want to give to the borrower, you do you do a minus on that. Okay, so the loan account will be minus to start with. And as you pay the loan, it goes back and offsets back to zero. This is exactly the same logic that Goldsmith did, okay, manually, but now the banks are able to do it much more efficiently, much more easily using the electronic ledger. So credit creation became very, very simple, okay, and banks were quite happy. And the result was that during a credit expansion cycle, right, the economy goes to expansion and contraction, right? During a credit expansion cycle, the amount of money that the bank actually spinned off as credit just boomed, right? It's just like a bubble. It went into the economy, it created boom and bust cycles. So bank had actually all the control to create the credit, and banks were considered the fuel for driving economic growth. Okay. Of course, when it is contracting, it created burst, right? So there were problems. So the question is then, if banks can create credit and fill the system, fill the economy, what stops them really? Is nothing stopping them? Yes, there is some things that are stopping them, okay? One of the reasons is that to create loans, they need to find credit-worthy customers, which is okay, not a big problem, okay? But at least they were limited by the customers who were credit-worthy. That was some limit, even though it wasn't a big limit. The actual limit is when you actually have this bubble money, like millions of dollars or whatever in your bank, if all the customers of the bank would actually to take this bubble, this whole millions of dollars, and move to another bank, then there is a problem, because the money has to actually pass through a system called RTGS in the central bank, right? So you need to actually keep an equivalent of that money in the central bank to move it. So that acted as a barrier, because to have central bank money, the bank to have central bank money in central bank, they need to have assets, right? Central bank will not give you liquidity unless you have assets. So the ability to actually find assets and keep in the central bank acted as a limit for banks to actually create the amount of credit they could roll out into the economy, right? So there were limits. It was not that there is no limits. Fractional reserve ratio is still there in India. It's, I think, about 23, including the SLR, but many of the advanced countries, there is no fractional reserve. In UK and in US and in most of the European Western world, there is no fractional reserve. The only limit the banks have to actually roll out new money or new credit is this central bank limit in the RTGS system in the form of liquidity. So I hope this explains, what actually the end result is, or the moral of the story is that there are two forms of money, right? The first form is the central bank money, which is the original money, which are backed by assets, which we have access to through cash and coins. And the second part is the commercial bank money, which they actually roll out as credits, okay? All the money, 90% of the money that is in the world today is actually a credit. That's why it's called a credit-based economy. Today we live in a credit-based economy. Every money that you have in your bank account is a credit that was spun off sometime in the past and waiting to be retracted into a loan, existing loan, right? But it never gets retracted because new and new loans keep coming out into the economy. So if CBDC is our chance to retain or have central bank money, would you have it or not? Of course you will have, right? So that's the moral of the story. Now we'll come back to the CBDC implementations. Okay, this is a domestic setup. What the central bank needs to do, or the government needs to do, is to actually first select a DLT provider, okay? A blockchain-based DLT provider. It could be Ethereum, it could be R3, it could be Quorum. There are many providers out there. R3 is the most popular one, I guess, but Ethereum is also picking up in various other ways. So central bank needs to choose one provider, okay? That is the first thing. India can build our own DLT platform. Maybe CDAC can build it, no problem. But they need to choose somebody and then implement the so-called central bank nodes first, okay? And the central bank nodes are associated with the reserves of the central bank. Then they need to onboard banks. So the banks will come in, Bank A has come in, and they get a node. Bank B comes in, and they get a node, right? So it's called DLT nodes. They are basically store of the blockchain information, including the ledger. So once the banks are onboarded, the system is ready, right? The whole DLT network is ready. What then happens is that you onboard the customers, right? The retail customers. So Bank A onboards customer A and customer A1 and customer A2. Bank B onboards customer B. So basically when you onboard, you get a wallet, okay? In this wallet, so those are the wallets, CBDC wallet, right, in your mobile banking. So you give your commercial bank money or your money in your account, and then you get CBDC equivalents, okay? Bank will give that. Bank is liable to give it because they believe in the so-called singleness of money. Everything is same, so they are liable to give you CBDCs or central bank money on your demand. So you can exchange your money in your account with CBDC within the wallet, and from that wallet, you can actually start transacting this CBDC. So whenever Bank B is transacting with Bank A, Bank A is transacting with Bank B, then what happens is the central bank takes the bank's reserve, and they convert that to CBDC and provide it to the banks. So it's a very simple flow. The bank requests central bank to mint CBDC. That is the first process. So it is the terminology is very close to how you mint coins, right? So bank requests central bank to mint CBDC first. Then central bank take the bank's reserves, because it has to be backed by reserves, and mints the CBDC. Then central bank issue the mint in CBDC form to the banks. So as you can see, there is a central bank CBDC account, and there is a Bank A CBDC account. So when the mint happens, okay, central bank moves that mint to the Bank A CBDC account as well as Bank B CBDC account. Then as a customer, as I told you, you have the wallet, then you buy that CBDC, right? And then you transact. With CBDC, you can transact with CBDCs, you could go to some crypto exchanges. In future, you could be able to go to private exchanges, you could do the transactions and all that. Then when you are done, or when you want to actually redeem some of the CBDC, then you can sell, okay? So when bank has surplus CBDC, they can redeem back to the central bank, and central bank then burns it off. So it's minting and burning, right? So it's exactly same terminologies that we have seen in cash and gold coins. So now I want to actually go to a very important use case, which is on the wholesale space. And this is about cross-border payments. Cross-border payments means the time. Oh, sorry, 5 minutes? Okay, within 5 minutes. So this is the most important use case of CBDC, that today the cross-border payments, international payments, if I pay somebody from here to Canada, it is very expensive, it is very slow, there is no transparency at all. We don't know how much money actually gets there because so many hops in the path. It's very complex, and it is run by private network. It's called SWIFT. It's a consortium of banks. There's no innovation that happened in the space for a very long time. And most importantly, which is what actually bothers me, that international transfers doesn't go through central banks. Okay, it is all done through private ledgers of private banks, very big banks. So this is just an illustration. If you are a sender, it's a basic case. If you are a sender of the money, you have your bank, the beneficiary has this bank, and the sender needs to find a correspondent of that currency to send that money. So, and then the correspondent has to find a correspondent at the other end to actually get the money there. So there are 4 banks in the chain. In very complex cases, okay, there are up to 9 banks in the chain, because it's very difficult. It's like you'll go Google Maps. You say go from here to there. Google finds this route, right? From small roads to big road, the main road, the highways. So it's actually connecting a lot of these small things and getting the path ready. So it's a very, very complex affair. Everybody in this chain takes a little bit of a charge, right? And then reconciliation of the charges, it's a very, very complex affair. When something goes wrong, banks have very, very difficulty in finding, repairing it, getting back the money, tracking where it is. So what CBDC brings is the wholesale CBDC, where the banks, the Reserve Bank of India has their CBDC account, Reserve Bank of Australia has their CBDC account. What they do is actually they create a bridge, right? An FX settlement bridge between each other, and then they start to settle through the CBDC network. Okay, how it happens is like this. So that's the DLT network of India. This is the DLT network of Australia. So there is Axis Bank, there is SBI Bank, there is ANZ Bank, there is Westpac Bank, right? So these are the banks in respective countries. Central banks are in the middle, right? So this bridge that is in the middle, that allows for bilateral foreign exchange transactions. Right now you need to go to dollar or euro, but CBDC allows to settle with your own currencies, right? So that's the greatest advantage that it brings. Why I showed that in different colors is because DLT India might have done in Ethereum, Australia might have done in something else. So there has to be a communication, a bridge that needs to be built, because they're not same, right? They need to talk in certain. So that's the bridge that we need to build. Many players are out there to build these bridges, but this is the mechanism, this is the arrangement that will eventually be, and taking off all the private players from this very, very important business of international money transfers. Okay, 2 more slides. Innovations around CBDC. Actually, the innovations are going to explode in the years to come. The most important one, I pick only one item, tokenization. Tokenization of real world assets, okay? You could, in future, tokenize your assets. If you have a land, if you have a property, you have an apartment, you have a car, you got a laptop, you got a pen, you got art, you photograph, anything, you could digitalize them or tokenize them, and then you can put it in the blockchain, right? So it becomes a token, and then you can use it as an asset to borrow, okay? And so this is basically, so you could actually monetize your assets much more easily than actually taking your, let's say, collateral, your sale deed to the bank and going through all that haggles. The second thing is, you don't have to actually monetize the whole property. If you want a portion of the property to be tokenized, and you just want to lend against that or borrow against that, then you can do that, right? So it's basically partitioning your whole asset. So there's a lot of use cases around this. You can look for tokenization of everything in YouTube, and you will find this. Okay, I'll skip the second part. DeFi is again privatized platforms for decentralized finance. Okay, last slide is the technology behind CBDC. As you know, it's built on digital, it's based on distributed ledger. Okay, it is run by blockchain. Okay, and underlying the blockchain is cryptography, everybody knows, and underlying the cryptography is digital signatures, right? So digital signatures actually is the fundamental building block for all these innovations that are happening around the world, around CBDCs and cryptocurrencies. So there's no need to actually, overemphasize the fact that it actually applies in all the aspects of CBDC, right from issuance of the CBDC, authentication, communication, everywhere. Okay, so with that, I will stop this presentation. Thank you very much for listening. These are my blogs in Finextra. If you like to have it, you can take a look. Thank you again.